Joining me is Mark Smith. He's the Senior Vice President and Portfolio Manager at Wells Fargo Advisors. Mark, it's good to see you again. And tell me what gives you, some reassurance here.
Thanks for having me on, Kelly. What gives me reassurance is that in the last 40 years, there have been 6 major rate hikes that have happened. And almost every single one of those times, except for one, the market has been up, in some cases double digits. So if you're just looking historically, the economy is able to maneuver rate hikes pretty well.
I see here there's only once in the last 40 years that hikes resulted in a down market. Was that the episode we hope we're not living through this time around?
Right. Tech was what did it last time with the tech bubble, right? And so we're hoping that tech, given some of their earnings and recent reports, even though we're seeing a downturn in some kind of 40% downside from the all-time highs in tech, we're hoping that some of this has been a little bit overdone, and so that won't be repeated. But yeah, that would be it. The last time was 2000 during the tech bubble.
Well, I would say that episode might give people, unless you're in those stocks, people more broadly some comfort because, you had markets overall, very different story. You had the economy in only a 6-month shallow recession, and that was with 9/11 and everything else going on. So, that would be a much more reassuring outcome, I think, than if we're talking about a repeat of the 1970s when stocks did pretty terribly.
Right, exactly. And so what I think that we need to look at is where is there opportunity right now that we know that these rate hikes are going to be happening. I think right now financials are a great place to be. They're one of the few sectors that when rates go up, they continue to make money and make more than they did when rates were lower. So you got to go in that. And then you're also seeing energy as a sector. Going back, all those different rate hikes also performed very, very well in all 6 of those different examples I gave earlier.
I'm thinking back to the Paul Volcker era of the early 1980s when we had a double-dip recession. The first one was sort of shallow, the recession. The second one, in response to more of his tightening, was pretty deep and pretty long-lasting. And that's the whole debate we were just having with Bill Lee just now, which is, can the Fed kind of keep inflation down without repeating that episode? And how telling do you think that double-dip recession is for what we might now have to go through?
Yeah. Powell has a very tricky performance he has to do over the next 2 years, and that is to possibly give 11 rate hikes without completely killing the economy. And so good luck to him on that task. I think it's going to be a difficult one because he's looking at really short-term data and making long-term strategic plays. So this is not going to be an easy thing for him. And I think that's what most investors are seeing, specifically my clients, is finding the reason to go aggressively in the equity markets, knowing that this has to happen. Inflation is at 40-year highs, and the Fed has to act. And by them acting, could they be actually slowing an economic recovery and possibly creating a recession? All that remains to be seen. And so Powell's going to write a really good book about all this at the end of it because we're all waiting to find out what's going to happen in the future.
So you mentioned financials.